If you've ever faced that absolutely crushing weight of financial difficulty where you are drowning in debt, maybe staring down a foreclosure notice or an impending car repossession, it feels like the end of the line.
Oh, absolutely. It's a paralyzing feeling.
But here's the crucial caveat. What if you know you have a steady job, you have a regular income, and all you really need is a court-mandated financial reset button, a highly structured path forward that lets you actually keep your house and your car?
That feeling is precisely the point where the legal system offers relief. Most people, when they hear the word bankruptcy, immediately jump to the most dire scenario: liquidation, complete financial destruction, and losing all their
It's
assets.
Chapter 7.
That's Chapter 7. But the law, Title 11 of the U.S. Code, provides a very powerful alternative.
Exactly. Today's deep dive is into that alternative, the powerful, complex mechanism of Chapter 13. It is often nicknamed the wage earner's plan, and we're going to explore why that nickname is so accurate. This filing is fundamentally about reorganization, rehabilitation, and asset retention, not surrender.
And what's fascinating here is that the core purpose of Chapter 13 is to empower an individual who has a regular source of income, a necessity we'll detail shortly, to propose a multi-year structured repayment plan under the strict protection and supervision of the bankruptcy court.
Right.
It's an aggressive use of judicial power aimed at giving debtors a viable future.
So our mission today is to unpack this section of the code. We are going to contrast Chapter 13 sharply with the better-known Chapter 7. We will explain the gatekeepers, the eligibility rules, especially the hard debt limits, and we will detail the truly powerful judicial tools a debtor gains, such as stopping foreclosure and forcing creditors to accept new loan terms.
Our source material lays out a comprehensive overview of this entire structure, detailing the specific requirements, the crucial advantages that can rewrite debt contracts, and the significant disadvantages, like the lengthy impact on credit that filing under Chapter 13 entails.
The big idea to keep in mind throughout this deep dive is that Chapter 13 provides court-mandated reorganization. If you have income, you can use this framework to get judicial approval to restructure how you pay virtually all classes of creditors over a defined 3 to 5 year period. Okay, let's unpack this, starting with the foundational legal architecture. So let's start high up, looking at the menu of options within U.S. bankruptcy law, which is Title 11 of the United States Code. When an individual faces unmanageable debt, they are usually steered toward two primary consumer chapters, 7 or 13.
That's right. And Title 11 is structured to address all sorts of financial distress. Beyond individual relief, you have, for instance, Chapter 9 for struggling municipalities, like cities or counties.
Oh, interesting.
And Chapter 11 is traditionally for major corporate reorganizations, though it also becomes the mandatory route for high-debt individuals who exceed the financial limits of Chapter 13. We'll get into that. Then you have Chapter 12, which is specifically tailored for family farmers and fishermen.
But for the vast majority of individuals, the decision process boils down to that fundamental choice between Chapter 7 and Chapter 13. So what defines Chapter 7?
Chapter 7 is defined by liquidation and discharge. The law explicitly states that Chapter 7 does not provide for a reorganization plan. The process is quick, typically concluding in just 3 to 6 months, and it focuses on the discharge, or legal elimination, of certain qualifying unsecured debts.
But there's a trade-off, a big one.
A huge one. The trade-off is often severe. The debtor must surrender any non-exempt property to the bankruptcy trustee, who then liquidates that property to pay creditors. It's a fast, clean break, but you potentially sacrifice assets.
Chapter 13, on the other hand, sounds like the polar opposite. It's the structural slow-burn approach.
That's right. Chapter 13 is the chance to propose a proactive, multi-year plan. It's the mechanism that allows a debtor to manage and repay various classes of creditors over a defined time period while retaining their property.
And that's the key.
This is the crucial differentiator. Chapter 13 allows you to keep your home, your vehicles, and any non-exempt assets, provided you commit your disposable income to repaying creditors through the plan.
That retention of assets is huge. I mean, if I'm 6 months behind on my mortgage, Chapter 7 might wipe out my credit card debt, but it won't automatically stop the bank from foreclosing on the house because the mortgage is secured debt.
Precisely. In Chapter 7, if you want to keep your house, you have to reaffirm the debt and cure the arrearages quickly, which is often financially impossible for the debtor in distress.
You're already in a hole.
Exactly. Chapter 13, however, provides the judicial mechanism, the legal oxygen, to spread those past due payments, or arrearages, over the full life of the 3 or 5 year plan. It literally cures the default, allowing the homeowner to catch up gradually while the foreclosure is permanently stopped.
Now, I've often heard people who are filing Chapter 13 say they're doing it because they couldn't qualify for Chapter 7. This moves the choice from a preference to a necessity, doesn't it?
It absolutely does. And this brings in the critical concept of the means test. The means test was introduced to prevent higher-income individuals from abusing Chapter 7's liquidation provisions when they clearly had the ability to repay a portion of their debts.
So how does the means test force someone into Chapter 13?
The test is complex, but in essence, it looks at the debtor's income relative to the median income of their state and then calculates their available disposable income.
Okay.
If the debtor's income is above the state median, they must pass a second analysis to demonstrate they don't have enough disposable income to pay a significant percentage of their unsecured debt over 5 years. If they fail, the means test, meaning the court determines they do have the capacity to repay, they are generally presumed to have filed Chapter 7 in bad faith.
And the court doesn't like that.
No. The court will often dismiss the case or, more commonly, pressure the debtor to convert the case into a Chapter 13 filing.
So, for many debtors, Chapter 13 isn't just the preferred path for keeping assets, it's the only pathway to bankruptcy relief available to them, because Chapter 7 is off the table due to their income level.
That's the key insight. For above median income earners, Chapter 13 becomes a mandatory restructuring tool. It ensures they get relief, but only on the condition they devote their excess income to repaying creditors for 5 years.
Earlier, I asked about the comparison to debt consolidation. Can we elaborate on why that label is just, too simplistic for Chapter 13?
We must stress that commercial debt consolidation is merely a private arrangement, usually focused only on unsecured debt like credit cards, and it offers zero protection against lawsuits or secured creditors.
So it's not legally binding on everyone.
Not at all. Chapter 13, being a judicial process, transcends this. Our source material highlights that Chapter 13 handles things commercial consolidation cannot touch. It can stop foreclosure on a house, force the repayment of priority tax claims, and even manage domestic support arrearages like past due alimony or child support under court supervision. It's not consolidation. It's a court-mandated financial overhaul.
Moving to a rare but important context. Involuntary bankruptcy. We assume the debtor initiates the process, but creditors can occasionally force a filing.
That's correct. Creditors can, under strict legal conditions, force a person or a company into involuntary bankruptcy. However, they are restricted to forcing the debtor into Chapter 7, which is liquidation, or Chapter 11, which is reorganization, but typically for businesses.
They can't force you into Chapter 13.
They cannot force an individual into the voluntary wage earner-focused Chapter 13.
But the debtor isn't left without recourse if they are forced into, say, Chapter 7.
No. There is a crucial procedural safety valve written into the code. If a debtor is subject to an involuntary Chapter 7 or Chapter 11 filing, that debtor retains the absolute, non-waivable right to convert that forced proceeding into a voluntary filing under Chapter 13.
As long as they're eligible.
Provided, of course, they meet the eligibility criteria we are about to discuss. Yes. This conversion right ensures that the individual always has the option for a structured repayment plan if they have the income to support it, rather than being forced into liquidation.
So we've established that Chapter 13 is a powerful asset-retaining reorganization tool. But it's not for everyone. You have to pass the financial gatekeepers. Let's start with the most basic requirement, the income necessity.
This is fundamental. Chapter 13 hinges on future payments. Therefore, the debtor must possess a necessary regular source of income to fund a viable plan. This can be wages, salary, commissions, income from self-employment, Social Security, pension payments, or even rental income.
What if a person lost their job right before filing? What then?
That's a great question. If the debtor is currently unemployed and has no steady source of income whatsoever, no unemployment benefits, no pension, no spousal support, they are automatically disqualified from Chapter 13.
It's just flat out.
Flat out. They would have to seek Chapter 7. Because without a reliable stream, the commitment of a multi-year repayment plan is impossible to guarantee. The income stream proves the debtor's ability to commit to the plan.
Now let's get into the hard numbers that define the scope of Chapter 13. These statutory debt limits are often what surprises people. We are talking about Section 109.
These figures are critical as they act as a cutoff for the streamlined individual process. The numbers are indexed and adjust periodically, but based on our source material, the current thresholds are very specific and must be satisfied as of the date of filing.
Okay, so what's the first limit? This applies to unsecured debts.
Yes. Unsecured debts, So that's your credit cards, medical bills, personal loans not tied to collateral must be less than $419,275.
And the limit for secured debts.
Secured debts loans backed by collateral like a primary mortgage, second mortgage, or car loans must be less than $1,257,850.
Why are those specific numbers so important for you, the listener, to know?
They define the ceiling of Chapter 13 relief. If your total debt, secured or unsecured, creeps even slightly over those figures, the door to Chapter 13 slams shut. The consequence is massive. The debtor is forced into the highly complex corporate reorganization framework of Chapter 11 simply because their debt load is too high for the wage earner chapter.
You used the word onerous earlier when describing Chapter 11 for an individual. Let's explore that. If I'm a high-debt individual, say I own several rental properties and my secured debt is $1.5 million, why is Chapter 11 so much worse than Chapter 13?
Well, Chapter 11 is designed for massive, ongoing corporate reorganization. For an individual, it's financially crippling and procedurally exhausting. There are two primary reasons it's so onerous. First, the cost. You are subject to quarterly U.S. trustee fees.
What are those?
These fees are based on the total amount of disbursements made during the quarter, and they can run into thousands of dollars, acting as an additional mandatory tax on the reorganization process. Chapter 13 does not have these fees.
That immediately adds a huge administrative cost. What about the procedural burden?
The procedural burden is immense. In Chapter 11, the debtor is classified as the debtor in possession, or DIP, essentially acting as their own manager under court supervision.
So you're running your own case, basically.
In a way, yes. You have to file monthly operating reports, which are detailed financial statements proving your viability. You had to gain court approval for almost every major transaction, including selling assets or entering into any new financing.
So Chapter 13 is designed for a single family to manage their finances, whereas Chapter 11 treats that same family like a small corporation under constant audit.
That is the perfect analogy. Chapter 13 is efficient and designed to be managed by a standing trustee. Chapter 11 requires far more legal time, higher fees, detailed disclosure statements that must be sent to all creditors, and potentially creditor voting on the plan. The debt limits, therefore, function as a crucial filter, keeping the vast majority of individual debtors in the simpler, more affordable Chapter 13 system.
Okay, so once a debtor is deemed eligible, they have the income and they meet the debt limits, their plan has to provide for 4 general categories of debt. It sounds like a hierarchy.
It is a strict legal hierarchy codified in the Bankruptcy Code. The plan must meticulously detail how it will treat each claim according to this ranking, ensuring the highest priority debts are fully addressed.
Walk us through the 4 categories the plan must address.
Okay, first up are priority claims. These debts receive the highest standing. They include certain recent tax obligations like income taxes less than 3 years old, and most critically, domestic support obligations, alimony, and child support. These generally must be paid in full over the life of the plan.
Non-negotiable.
Absolutely. Second, secured claims. These are debts tied directly to collateral, meaning the creditor has a lien on property. Think of your home mortgage or car loan. The plan must provide adequate protection for these creditors, often through curing defaults or applying the cram-down rule we'll talk about. Third is a smaller group, priority unsecured claims. This is a nuanced group of unsecured debts that the code gives special treatment to, usually related to certain types of business expenses or customer deposits, though they are less common in standard consumer cases.
Okay, and the last one is the big one for most people.
It is. Number 4 is general unsecured claims. This is the large bucket of liabilities where most people are overwhelmed. Credit cards, medical bills, older tax claims, personal loans, and deficiency balances after a car repossession. These are the lowest priority and often receive only a fractional repayment, based solely on the debtor's disposable income.
That comprehensive framework is necessary to ensure every obligation is accounted for, which brings us to the actual execution of that framework, the mechanics of the plan. The Chapter 13 plan is the operational document, the blueprint for the next several years of the debtor's life. Let me talk about the timeline. When does this reorganization clock start ticking, and how long does it run?
The duration is strictly defined by statute and cannot be exceeded. Chapter 13 plans are usually 3 to 5 years in length, and critically, they may not exceed 5 years.
So that's a hard stop.
It's a hard stop. If the debtor, even hypothetically, needed 5.5 years to cure their mortgage arrearages or repay priority taxes, Chapter 13 would be unavailable to them.
And commitment is proven immediately. You don't get months to breathe before you start paying.
Far from it. Repayment according to the plan must begin quickly. The source materials indicate within 30 to 45 days after the initial case filing. These payments go to the appointed Chapter 13 trustee, who manages the funds and distributes them to creditors according to the court-confirmed plan. This swift start proves commitment and establishes the necessary cash flow structure early on.
Now let's talk about the instant relief afforded upon filing, which is the cornerstone of the whole system, the automatic stay. Explain what this legal shield does, both procedurally and psychologically.
The automatic stay is arguably the most powerful feature of the entire bankruptcy code. It is an immediate injunction that halts nearly all collection activities by creditors the moment the petition is filed.
The very second it's filed.
The second. Procedurally, it stops lawsuits, judgment enforcement, wage garnishments, harassing phone calls, and, crucially, for asset retention. It stops foreclosures, repossessions, and forced evictions based on non-payment of debt.
That immediate cessation of all collection activity must be an incredible relief.
It provides the necessary oxygen. Think about the psychological state of someone juggling dozens of creditors, facing constant pressure. The automatic stay provides that immediate breathing room, allowing the debtor and their attorney the necessary time, those 30 to 45 days, to finalize the detailed long-term plan without the imminent threat of losing their home or vehicle.
Right. Without that, the plan is dead on arrival.
Exactly. Without the stay, reorganization would be impossible.
Are there any limitations to the automatic stay? Can it stop, say, a criminal proceeding or a tax audit?
That's a good clarifying question. The stay is comprehensive, but it has important exceptions. It does not typically stop criminal proceedings, nor does it halt the collection of domestic support obligations, child support or alimony, that accrue after the filing date.
Ah, so it's for pre-existing debts.
Yes. It also allows certain regulatory actions by government agencies to proceed. Its primary function is to freeze the financial landscape concerning pre-petition debts, creating a clean environment for reorganization.
Let's move to the practical applications. The automatic stay is the shield. Chapter 13's tools are the swords. What are the common scenarios where a debtor uses Chapter 13 to save their assets and secure their future?
These are the aha moments that make Chapter 13 invaluable. The source material details several core applications. First, and this is the big one, curing mortgage arrearages, stopping foreclosure.
A flagship use.
It really is. If a debtor is delinquent on mortgage payments, the plan splits the debt. The regular ongoing mortgage payment continues to be paid outside the plan, while the past due amount, the arrearage, is bundled into the Chapter 13 plan and paid off in installments over 3 to 5 years. This reverses the default and permanently stops the foreclosure process, provided the debtor successfully completes the plan.
Amazing. What's next?
Next is something called lien stripping, or avoiding junior liens. If a debtor has a first and second mortgage and the home's value is less than the balance owed on the first mortgage, meaning the second mortgage is entirely unsecured, Chapter 13 allows the debtor to strip off that junior lien. It is reclassified as general unsecured debt.
Wait, hold on. You can legally remove a second mortgage entirely and treat it like a credit card.
Yes, provided the home value is zero or less than the amount owed on the first mortgage. For instance, if the home is worth $400,000, and the first mortgage is $420,000, the second mortgage, even if it's $50,000, has zero collateral backing it. The court strips the lien, the $50,000 goes into the unsecured bucket, and when the debtor completes the plan, that lien is permanently extinguished.
Wow. That simplifies everything for a future sale or refinance.
Massively. The third common use is paying back taxes over time. Priority tax claims, like income taxes from recent years, must be paid. But Chapter 13 allows the debtor to pay the full amount of those taxes, interest-free, over the entire 3 to 5 years of the plan.
Interest-free is a huge deal with the IRS.
It transforms an overwhelming tax bill into manageable monthly installments. And finally, there's a fascinating recent development. Some courts have allowed Chapter 13 to be used as a platform to expedite a mortgage modification application.
How does the bankruptcy court expedite a modification? Doesn't that still require the lender's cooperation?
It does. But the court provides the procedural pressure. Many districts utilize a specific court-supervised loss mitigation program within the Chapter 13 framework. This forces the lender to communicate efficiently with the debtor, review the modification application, and often participate in mediation, all under the shadow of the automatic stay.
So it brings them to the table.
It brings them to the table and keeps them there. It doesn't guarantee a modification, but it prevents the lender from dragging its feet, which is often the biggest hurdle outside of bankruptcy.
That just shows the flexibility of Chapter 13 as a living legal document, continually adapting to provide solutions for debtors in crisis. We've established the immediate protections. Now, let's confront the trade-offs, the financial sting of reorganization versus the extraordinary legal superpowers Chapter 13 grants. Let's start with the long-term pain, the disadvantages.
The debt relief is profound, but the consequences are multi-layered. The most immediate concern for a debtor is the impact on their financial reputation.
Right, the credit report impact is significant.
Absolutely. The bankruptcy filing remains on the individual's credit report for up to 7 years from the date of filing for Chapter 13. Now, while 7 years is a long time, it is important to note the contrast. Chapter 7 liquidation stays on the report for 10 years.
That's a big difference.
It is. And this difference reflects the law's view that a structured repayment and reorganization is less damaging to a person's credit future than a complete liquidation.
Beyond the credit report, the long duration of the plan itself, 3 to 5 years, creates a serious constraint. What is the primary restriction during those years?
That's the second major disadvantage.
Yeah.
New credit restrictions. For the entire duration of the plan, the debtor is strictly not permitted to incur new debt without the explicit permission of the bankruptcy court.
For anything.
For anything. This applies to new credit cards, new leases, or even refinancing existing obligations.
So if I need a new car loan halfway through my 5-year plan because my vehicle breaks down, I can't just walk into a dealership.
You cannot. You must file a formal motion to incur debt with the court. The court will review the necessity of the debt and ensure that the interest rate and payment structure will not jeopardize the successful completion of the existing Chapter 13 plan.
That sounds like a hassle.
It's an administrative hurdle that adds time and legal cost to necessary borrowing, and it keeps the debtor financially tethered to the court until discharge.
And even if the court approves it, the market itself is still punitive.
Precisely. Regardless of court permission, the act of filing Chapter 13 signals risk to the market. The source notes that creditors often charge exorbitant interest rates or simply refuse to lend entirely during the case's pendency. The debtor must be prepared for 5 years of extreme financial austerity and control.
But once the finish line is crossed and the discharge is granted, the recovery timeline is surprisingly positive, reflecting the fact that the debt was managed, not just wiped out.
The active management is the key. The source indicates that new non-predatory credit auto loans or consumer credit can often be obtained within 12 to 24 months post-discharge.
That's pretty quick.
It is. For housing, the timeline is constant. An FHA mortgage requires only 25 months post-discharge, and conventional loans backed by Fannie Mae and Freddie Mac require 36 months. This structured path to mortgage eligibility contrasts starkly with the often indefinite period following a Chapter 7 filing or a standard foreclosure.
Okay, that's the sting. Now let's talk about the superpowers, the things Chapter 13 can do that Chapter 7 simply cannot touch. Let's start with the technical but incredibly powerful feature, the super discharge.
The super discharge is what makes Chapter 13's relief exceptionally broad. While amendments have narrowed the gap, Chapter 13 still discharges liabilities that Chapter 7 explicitly deems non-dischargeable. This is the single greatest advantage for a debtor facing specific, complex legal liabilities.
Give us some tangible examples of debts that the super discharge handles.
Okay, super discharge provides relief in 3 major areas. First, certain tortious damage claims. Chapter 7 explicitly protects debts arising from death or personal injury caused by the debtor's operation of a motor vehicle while intoxicated, a DUI. However, if the judgment arises from, say, simple negligence, a reckless driving accident that wasn't intentional or drug or alcohol related, that resulting liability is dischargeable in Chapter 13, even if it's a massive amount. It distinguishes between malice and simple wrongdoing.
Fascinating. What's number 2?
Untimely filed tax claims. While recent taxes are priority claims that must be paid, older taxes where the IRS failed to file their claim on time during the bankruptcy case, or certain trust fund recovery penalties, can be discharged in Chapter 13, but often not in Chapter 7.
Okay, and the third one sounds like a big deal.
It is. Non-support marital settlement debts. This is huge. Chapter 7 was amended to make virtually all divorce-related property settlements and hold harmless agreements non-dischargeable.
So you're stuck with it.
You're stuck. Chapter 13's super discharge, however, allows property equalization payments or certain indemnification agreements arising from a marital settlement that are not deemed domestic support obligations to be discharged as general unsecured debt.
So if you were ordered to pay your ex-spouse a $100,000 lump sum property settlement, Chapter 7 won't touch it, but Chapter 13 can potentially treat it as an unsecured claim pay pennies on the dollar, and then wipe out the rest. That's a massive tool for people reeling from a difficult divorce.
It is the ultimate relief for high-stakes, complicated personal liabilities.
Yeah.
And that power to alter liabilities leads us directly to the concept of the cram down.
Cram down and valuation. This is the court unilaterally rewriting the terms of a private loan contract. How does the court gain this authority, and how does it work mechanistically?
This power is rooted in the court's authority to determine the true value of the collateral backing the debt. The process is called valuation and bifurcation. The court determines the current fair market value of the asset. The creditor's claim is then split or bifurcated into two parts: the secured claim, which is equal to the current collateral value, and the remainder, which becomes an unsecured claim.
Give us a clear vehicle example, as this is where it's most commonly used.
Okay, let's say you owe $40,000 on a truck loan, but the truck's current resale value is only $25,000.
So it's underwater?
Deeply. Under Chapter 13, the court bifurcates the debt. $25,000 becomes the new secured claim, which the debtor must pay back in full over the plan, but at a court-mandated lower interest rate. The remaining $15,000 becomes unsecured debt, treated exactly like a credit card bill, which may only receive a 5% payout and is then discharged. The court crams down the value the creditor is secured by.
And what about the interest rate that the court forces? Does the creditor have a say?
The court forces a reasonable interest rate using a standard, often based on the prime rate, plus a risk factor, commonly referred to as the till rate, named after a key Supreme Court case. This mechanism prevents creditors from charging high pre-petition contract rates that make the plan impossible to complete. The court's justification is that the creditor is protected because the asset is being paid for at its current value, at a fair market rate.
But I've heard there's a major exception to this cram down power when it comes to vehicles, a big catch.
You are referring to the 9-day rule. The Bankruptcy Code prevents the cram down of a secured vehicle debt if the loan was taken out within 910 days, about 2.5 years before the filing date. Congress created this rule to protect new car lenders, ensuring that if you financed a car recently, the creditor is still entitled to their full contractual principal and interest payments, even if the car is technically worth less than the loan amount. This limitation forces debtors to think carefully about the timing of their filing.
That distinction is critical. It balances the extraordinary power of the court with protections for creditors who have recently extended credit.
Exactly. And the final superpower is the protection of co-debtors.
How does Chapter 13 shield non-filing cosigners?
If you file Chapter 13 and your parent or friend co-signed a consumer debt, for example, a personal loan or a student loan, Chapter 13 imposes a specific stay, preventing collection efforts against that non-filing cosigner for the duration of your case.
So your mom doesn't get harassing phone calls?
Exactly. This allows the debtor to successfully pay the debt through the plan without placing undue financial pressure on the cosigner.
Are there limitations to that co-debtor protection? Does it protect a business partner who co-signed a business loan?
Typically, no. The co-debtor stay is generally limited to consumer debts, meaning debts incurred primarily for personal, family, or household purposes. It usually does not extend to business partners or individuals who co-sign non-consumer obligations. The creditor retains the right to pursue those business liabilities outside the Chapter 13 case.
We've spent all this time outlining the tools and the plan structure, but none of these benefits, the cram down, the super discharge, the foreclosure defense matter unless the plan is officially approved by the bankruptcy court. That final step is confirmation.
The Chapter 13 plan document is the comprehensive roadmap. It's filed either with the bankruptcy petition or shortly thereafter. It details the treatment of every debt, every lien, every asset, and every payment the debtor proposes to make over the next 3 to 5 years.
And here's where the legal muscle is undeniable. Court approval without creditor consent.
This is a hallmark of reorganization bankruptcy. The bankruptcy court can approve the plan over the explicit objections of creditors, provided the plan meets the strict statutory requirements laid out in Section 1325 of the Bankruptcy Code.
So they don't get a vote.
They don't. Unlike Chapter 11, where certain classes of creditors might need to vote and approve, the Chapter 13 court acts as the ultimate arbiter, imposing the plan onto dissenting creditors if legal compliance is met. Creditors are observers, relying on the trustee to ensure the rules are followed.
So what exactly must the plan satisfy under Section 1325 to secure that approval? It sounds like there are 3 primary paths concerning unsecured creditors.
That's right. The debtor must prove that the plan achieves one of 3 outcomes regarding the general unsecured creditors. 1. No objection. creditors simply don't object to the plan. This happens often if the plan proposes a high repayment rate or if the unsecured debt is minimal. 2. Full repayment. The plan proposes to repay all unsecured creditors in full, 100% of the principal, over the commitment period. And 3, which is the most common scenario, commitment of disposable income. The plan commits all of the debtor's disposable income to the Chapter 13 trustee for the entire applicable commitment period. This means the debtor is paying everything they can afford after essential living expenses.
The third path seems most subjective. How do you define disposable income?
Disposable income is defined by the Code as income remaining after paying essential monthly expenses, food, housing, necessary utilities, transportation costs, and reasonable allowances for certain other expenditures. The trustee scrutinizes this calculation extremely closely to ensure the debtor isn't claiming lavish or unnecessary expenses just to reduce the payment to creditors.
So no steak dinners every night?
Not likely to fly. And for above median income debtors, there are specific IRS standards used to calculate acceptable expenses, making the process much more rigid.
And the fundamental principle tying all of this together is the best interest of creditors test.
This is the bedrock of fairness and the core statutory requirement under Section 1325. It dictates that unsecured creditors must receive at least as much through the Chapter 13 repayment plan as they would have received in a hypothetical Chapter 7 liquidation.
We need to illustrate this clearly. Let's create a hypothetical debtor to show the math.
Okay, sounds good. Assume a debtor files Chapter 13. The court must first perform the hypothetical Chapter 7 analysis. Let's say this debtor has certain non-exempt assets, meaning assets that Chapter 7 would liquidate. Let's say $20,000 in equity in a recreational vehicle, a boat or a second car.
Okay.
And maybe $5,000 in excess cash savings above the state exemption limits. And that's it.
So in a Chapter 7, the trustee would sell the boat and seize the cash, netting $25,000 for the unsecured creditors.
Correct. Therefore, the best interest test requires that the debtor's Chapter 13 plan must promise to pay unsecured creditors at least $25,000 in total over the 3 to 5 years. If the debtor's disposable income calculation only generates $20,000 in payments over those 5 years, the plan cannot be confirmed.
So the debtor is forced to choose between either increasing their monthly payment to hit that $25,000 minimum or converting the case to Chapter 7 and losing the boat and the cash immediately.
That's the precise trade-off. It's an effective check on the system, ensuring that Chapter 13 is never used simply to shield valuable non-exempt assets from creditors. It requires payment for the preservation of those assets.
Finally, let's revisit the commitment period distinction, which directly influences the duration of the payments and is tied back to the income we discussed earlier.
This is the final structural requirement. The applicable commitment period is determined by the debtor's income relative to the state median. It's a two-tiered system. First, below median income. If the debtor's current monthly income is below the applicable state median income, the commitment period shall be 3 years. This allows for a quicker exit from the bankruptcy system.
And for higher earners.
For a debtor who makes an above median income, the applicable commitment period shall be not less than 5 years.
So higher earners are required to commit 2 additional years of their disposable income toward creditor repayment, ensuring they leverage their financial capacity fully before receiving a discharge.
It creates equity in the system. If you have the capacity to pay, the law requires you to utilize it for a full 5 years to maximize the return to your creditors while retaining your assets. This mandatory structure ensures the balance between debtor relief and creditor rights is maintained throughout the confirmation process.
That was a tremendous deep dive into Chapter 13, revealing it to be a sophisticated, adaptive legal tool designed not just for debt relief, but for fundamental financial recovery while preserving a lifetime of assets.
To summarize the key takeaways, Chapter 13 is the path for reorganization, requiring a regular income and mandatory 3 to 5 year payment plan, contrasting sharply with Chapter 7's liquidation focus. We discussed the strict statutory debt limits that serve as the entry gate, those specific numbers that prevent high-debt individuals from accessing this streamlined relief.
We explored the powerful tools that make this journey worthwhile. The ability to stop foreclosures by curing mortgage arrearages, the power of the super discharge to wipe out typically non-dischargeable liabilities like certain tort claims or property settlements from divorce.
And the court's authority to use cram down to modify secured debt based on the collateral's current value.
And we broke down the critical importance of the confirmation process, especially the best interest of creditors test,
which ensures that unsecured creditors receive no less than they would have in a Chapter 7 liquidation, forcing the debtor to dedicate their disposable income or the value of their non-exempt assets toward the plan.
Reinforcing that understanding, Chapter 13 provides a crucial lens into the pathways available for individuals seeking a financial reset while preserving assets like a home or vehicle. It's a journey that demands discipline for 5 years, but the reward is a structured, court-sanctioned fresh start.
And this comprehensive look at Chapter 13 highlights the immense power granted to the bankruptcy court to act as an economic regulator. When the court approves a reorganization plan, it is effectively exercising sovereign authority to rewrite private financial contracts through the cram down or dissolve legal judgments via the super discharge without the consent of the original contracting parties. This raises an important question for you to consider. How does our legal system justify this unique power? Is the economic benefit of individual rehabilitation and allowing the debtor to remain a productive, tax-paying member of society always sufficient justification to override the fundamental legal principle of contractual inviolability? It speaks to a deep legal prioritization of human recovery over strict adherence to private agreements.
Something profound to mull over as you process the mechanics of reorganization. Thank you for joining us for this deep dive.